What's up tax fam? It's your friendly neighborhood taxman back again with another video designed to help you navigate the complex Australian tax system for businesses. So today's video is specifically for all you brokers out there running a finance business, and there are different things you need to know when effectively managing your tax. So here it is. Number one is your business structure. Number two is your tax deductions. If you're not claiming these, then you're seriously missing out. And number three is your employee PAYG withholding. So I'm going to run through all these three topics today so that you have a good understanding of what your tax obligations are, but also how to save on taxes. As a business owner myself, I've left a few extra business tips at the end of the video, so make sure to stick around for that. Okay, so first on the list, we have business structures. If you're running a mortgage brokering business or a finance business, you could consider a few different business structures. But first, you need to figure out whether you're a personal services income earner or running a business. If you're employed by Aussie Home Loans, for example, on a contract basis, and they are your only client paying you a regular monthly fee, then it's likely that you're earning PSI income and not really running a business. So you would only be able to account for your earnings in your personal name and pay tax in your personal name. Personal services income is quite complex, so I filmed a separate video for this, so make sure you check this out. With PSI out of the way, let's check out the different business structures. First up on the list, we have sole traders. If you're running a finance or broker business, this is probably one of the more risky structures. That's because you hold all the legal liability personally. So if anything happens to you, your personal assets are at risk. Also, a sole trader is probably not the best tax efficient structure because you'll get taxed at the individual marginal tax rate. That can go up to a whooping 45%. So if you already fall in that high tax bracket and you're running a risky business, maybe sole trader structures is not the way to go. Next, we have a company structure. This is definitely the most common structure for finance businesses and brokers. A company is a separate legal entity, so unlike sole traders, you have a degree of asset protection. Company creditors can't touch your personal assets as long as you're running a business properly. Also, a company has a 25% flat tax rate, which is much more lower than the highest tax brackets for individuals. A company will also need to lodge a company tax return, director's declaration, file minutes of meetings, and have an annual dividend statement. So there's definitely a ton of administrative responsibilities when running a business through a company. Some people also consider setting the business up in a trust. This was a popular structure back in the day due to the ability to distribute your profits to your family members, do some succession planning, and protect your assets as well. I find that as much as this sounds like a good idea, there are a lot of circumstances that need to be met to make this worthwhile. For example, you need to have a lot of family members that have a low income, and your family members must be over 18 years old as well. If you don't meet all the criteria, then the taxes can be quite high because you can't distribute the profits to them. But you'll need to know that if your business turnover is expected to exceed 75,000, you must register for GST, which is a 10% tax on goods and services provided. Commissions you earn from financial institutions usually have that GST component in them, which your company has to pay to the ATO when you lodge your business activity statements every quarter or every month. Another structure option would be to set up a discretionary trust and have the trust be a shareholder of the trading company. So the only difference here would be those company dividends will pass through the trust and be distributed to the beneficiaries through the discretionary trust, which could be family members or even another bucket company. Bucket companies are essentially eligible beneficiaries of discretionary trusts, just like your spouse or children. For more on bucket companies and how they work, you gotta check out my video that I've released. Instead of your company being a partial shareholder of a discretionary trust, you could opt to have 100% of your trust to own all the company shares. In my opinion, this is probably the best structure on the list for brokers and finance businesses because you have the benefit of the company tax rate, small business CGT concessions, and the 50% discount if you decide to sell the business as a whole, and the flexibility of then distributing the profits at your discretion using the trust. These CGT concessions include a 50% discount if you've owned the company for more than 12 months, the 50% active asset reduction, the retirement capital gains tax exemption when you move money into the super fund, and the small business rollover. Now, it's one of the more flexible structures, but also one of the most confusing structures out there. So you'll need to speak to an accountant to see how this would work in your circumstance. Okay, so the next topic is hiring employees and PAYG withholding. Moving on to your employee responsibilities now. So if you hire any employees for your finance or mortgage brokerage business, you must be aware of your obligations to all your employees. First off, you're bound to have those responsibilities disclosed in the banking, finance, and insurance modern award. The award is a legal document that outlines the minimum pay rates and conditions of employment for all your employees in that industry. It must be given out to every employee that you hire, and the award also requires businesses to pay a 10% superannuation guarantee on behalf of their employee to an eligible super fund when paying their wages. These payments are typically paid fortnightly, monthly, or every quarter. Another responsibility when it comes to employee payroll is PAYG withholding. When you pay your employees, you must withhold a certain amount of tax from their pay. You then send this tax to the ATO. The ATO calls this PAYG withholding, also known as pay-as-you-go withholding. You withhold these tax on behalf of your employees, and then they claim the amount withheld when they lodge their tax return at the end of the financial year. PAYG withholding will be paid to the ATO alongside with GST while you lodge your BASs per quarter per month. So all of this information, salaries and wages and superannuation and PAYG, must be reported to the ATO each pay run. To make things simple, the government introduced single touch payroll. With SDP, you report your employees' payroll information to the ATO at the time you pay them through the single touch payroll software. Another thing you need to consider when opening your finance or brokering business is workers' compensation insurance, especially if you're based in New South Wales or Victoria. So guess what? I have a video on business insurance as well. So if you're unsure on what's mandatory and what type of insurances you need for your business, best to check it out. And next on the list is tax tips. My favorite, tax deductions. There is so much opportunity to minimize your tax through tax deductions. But so many business owners just forget about it or don't claim it at all. So here's a common list of deductions you can be claiming each year. Home office expenses. If you run a home office, including stationery, telephone, internet costs, computer consumables, cleaning costs, heating, cooling and lighting, and depreciation of the home office furniture, office equipment, and computers. Car expenses, but you'll need to keep an accurate record of the substantial claim you're making. Mobile phone expenses, if you use it for work purposes. Again, record keeping is super important here. You can prepay expenses. You can claim a tax deduction this year for expenses that wholly or partly relate to the next year. So if you have spare cash, consider paying things like professional subscriptions in advance to accelerate the deduction for this year rather than next year. You could also contribute additional funds to your superannuation fund and claim a tax deduction for the contribution. And last, but definitely not the least, the instant asset write-off. The instant asset write-off allows small businesses to claim an immediate deduction on assets you've bought for your business throughout the year. These include office equipment, cars, and other tools you may need for the business. Before the 2020 federal budget speech, you could only claim an immediate deduction for business assets up to $150K. But now, that threshold is limitless. If you want to know more about this topic, make sure to check out my video where it explains the limitless instant asset write-off. Next up on the list is knowing how to draw money from your business. There are 3 different ways you can do this. The first option is a director's loan. You can borrow and lend money to and from the company, but you have to pay it back within the same financial year or else you'll incur Division 7A issues, which would then require you to either commercialize the loan or pay a dividend to pay back that money. Directors can also draw wages, and the same payroll obligations will apply as an ordinary staff. So you have to deal with superannuation contributions and PAYG withholding for your own wages. Lastly, company shareholders can also pay out dividends. No joke, I also have a detailed video on this too. So make sure you check it out as well. Okay, so these are the 4 most important considerations you need to think about when opening your brokerage or your finance business. Business structures, employee obligations, tax deductions, and drawings is what you need to know about. But as a business owner myself, I have a few other things that I want to share with you that you should keep in mind when running a business. The first one is to have a separate bank account for your business. And the best practice would be to have all your business expenses go through that business bank account. You'll be surprised how many people don't do this. The second one has to do with paying commissions to clients and referral partners. If you want to claim a tax deduction, the client or the referral partner needs to have an ABN and needs to provide a tax invoice for record keeping. This may get tricky if referral partners and clients don't run a business or have an ABN. A handy trick is to buy gifts or gift cards in replacement of referral fees. As long as the expense is directly linked to your business and encourages more referrals, then the ATO sees it as an advertising expense and it's tax deductible. If you're a finance broker, then you know how important it is to keep good records, and minimizing your taxes is what most businesses are after. But they do not realize that by writing off all your profits, you're reducing your ability to get business loans. So having good records and filing your taxes on time will allow you to borrow money to grow your investments and businesses. But you should already know that. Another thing that I've realized is that finance businesses tend to really struggle in their 3rd year of operations. In the 1st year, they're still finding their feet and reinvesting their profits back into the business, which means the profit is low. Low profit equals minimal taxes, so they don't pay much taxes at all. In the 2nd year, they're either generating a profit or remaining stagnant, but either way, they must make the important decision to grow their business or try something different. And then, depending on your decision in your 2nd year, you'll likely experience a couple of problems, especially if you haven't set up your business in a tax-effective way. Most new business owners forget about the income taxes when they start generating a profit. It's great that your business is growing, but you mustn't forget to account for growing tax bill at the end of the year as well. Growth also means more expenses, so you could end up with cash flow issues if you're not smart about your 1st and 2nd years. This part is where having a good accountant can really save you. Anyway, that's where I'm going to end it here. I hope you found this guide very helpful, and if you're a new business owner in the finance or brokering world, don't hesitate to reach out. Although I'm an accountant, I'm also a business owner, so I've been around the block a couple of times and would love to help you succeed. Oh, and don't forget, subscribe to my channel and click that little bell. Thanks guys, see you later.